You know, in the world of finance, some words get thrown around that can be really confusing. Take the word cross. It sounds so simple, right? But depending on who you're talking to, it can mean a weird market glitch, a totally normal trading strategy, or even a pretty controversial kind of deal. So, what's the real story? Well, let's dig in and figure it out. So, what does cross really mean when you hear it in a financial context? As we're about to see, it can refer to a rare glitch in the system, a common way to trade, or a type of transaction that regulators are, well, not too fond of. And if you mix these up, you can get seriously lost. So, in this explainer, we're going to untangle all of this. First, we'll look at the different meanings. Then, we'll dive into that weird crossed market glitch. After that, we'll talk about cross market strategies, tackle the controversial cross trade, and then at the end, we'll pull it all together and talk about why this stuff actually matters. Okay, first things first. Let's just get a handle on how many different hats this one little word wears. You'll hear it used in completely different situations, and honestly, knowing the difference is key to really understanding what's going on in the market. We're going to start with the most technical and, frankly, the strangest definition of them all, the crossed market. This is basically a momentary glitch where the fundamental rules of buying and selling just get turned completely on their head. A crossed market is this really abnormal temporary situation where the highest price a buyer is willing to pay, that's the bid, is actually higher than the lowest price a seller is willing to accept, that's the ask. Now, that is the exact opposite of how a market is supposed to work. It's just broken. And this slide really shows you that flip perfectly. See, in a normal, healthy market, the ask price is always going to be higher than the bid price. That little gap between them, that's how market makers make their money. But in a crossed market, that relationship completely inverts, and for a brief moment, you've got pricing chaos. So, what on earth causes a situation this bizarre? Well, it's usually a sign of some serious stress or a system malfunction. Think about things like computer glitches or pure panic selling during a market crash. For an investor, this isn't just some fun fact. If your order gets filled during one of these moments, you could end up paying a completely wrong price. The good news is, with modern high-speed trading, these have become a lot more rare. Okay, so we've moved from a rare glitch to something that happens every single day. This brings us to the second and much more common meaning of cross-market, as a deliberate and pretty powerful way to trade. Cross-market trading is pretty much what it sounds like. It just means you're operating across different but related financial arenas. So instead of just buying and selling one stock on one exchange, you're looking for opportunities by connecting the dots between different assets or different markets. Let's look at two great examples here. First up, currency crosses. It used to be that if you wanted to trade euros for Japanese yen, you had to go through the US dollar first. A cross trade like EUR/JPY lets you do it directly. That can save you money on transaction fees and reduces your risk if the dollar's value is jumping around. Then you've got cross-listed stocks, like a big company that trades in both New York and London. This can create opportunities for arbitrage if the price is slightly different on the two exchanges, even for a split second. And this idea of crossing over isn't just for finance. Think about cross-marketing. You know, like when a company that makes high-end boots partners up with a brand that makes premium shoe polish, they've got the same kind of customer, but they don't directly compete. It's the exact same principle as cross-market trading. You're leveraging related, but separate, areas for a win-win. All right, time for our third and final definition. And this one, well, this one comes with a bit of a warning label. We're talking about the cross trade, a practice that often lives in a regulatory gray area and can be really controversial. Yeah, the source material couldn't be clearer on this. You see it right there. Not allowed on most major exchanges. That's a huge red flag, and it tells us we are definitely not talking about a simple trading strategy anymore. So what is it exactly? A cross trade happens when a broker gets an order to buy and an order to sell for the exact same asset. And instead of sending both orders to the public exchange for everyone to see, they just match them up internally. The key thing to remember is that this happens away from the open market. Now, it's important to know there are two sides to this. A cross trade can be legitimate if a broker matches orders between two of their clients and then immediately reports that trade to the exchange at the current market price. But it crosses the line and becomes illegal when those orders are matched privately and never get reported on the public exchange, basically hiding the whole transaction from view. And this is why it's such a big deal. Unreported cross trades are really bad for market fairness. Think about it.
Other investors never even get a chance to bid on those shares, and they might have been willing to offer a better price. The clients in the deal might not be getting the best price available. And it opens the door to all sorts of manipulation, like creating a false impression of trading activity.
Okay, so we've looked at a pricing glitch, a trading strategy, and a controversial way of executing trades. Let's pull this all together and really hammer home why these distinctions are so incredibly important. Let's break it down one last time. This table lays it out nice and simple. A crossed market is a pricing anomaly, a temporary glitch. Cross-market trading is a perfectly normal strategy that connects different markets. And a cross-trade is a type of order execution that is super controversial because it can happen off exchange and lacks transparency. Three totally different concepts, all hiding behind one simple word. And that kind of leaves us with a final question to chew on. As our markets get faster and more complex, concepts like the cross-trade really force us to ask what we value most. So, in this world of high-speed algorithmic trading, how much does transparency really matter? And that's our look at the many, many meanings of the word cross in financial markets. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.